Good evening and welcome to our webinar where we take a closer look at the tools behind our 3-point playbook and our 3-point playbook portfolio. A portfolio that in 2025 hit an upside of 34.48%. And right now that is in, well, the market's in a crisis and we still beat the market with a couple of percentages. So we are absolutely fine right here. And Liam Flavel, the man to my right here, ready to take your answers, and we will take them both on chat and on email, fomo@mystockscanner.com, fomo@mystockscanner.com. That's our email, and do write us here on chat, and we'll see if we have time for questions. But Liam, interesting that we labeled this as a webinar about how to handle your portfolio in a crisis. And then I look up at all green. All the indexes today are totally green. But let's stress, crisis definition is there are good days in crisis as well. And then there are really bad days. Tell us about the crisis that we're in right now.
Yeah, well, the kind of crisis we're in right now is one about energy. And, we've got the Iranian situation at the moment where the Americans have come in to, do a certain, well, they don't even know what they're actually doing in there, I don't think. But what's actually the repercussion of this is that Iran have closed what's called the Straits of Hormuz. That has effectively closed off 20% of the world's energy, as well as other fairly important bits and pieces that that region gives us. And that is starting to cause a slow rolling crisis going forward. The markets have reacted a little bit. They dropped 10, 11, 12%. Potentially there's a lot more coming in as well in the future, but we'll talk about that as we go forward tonight.
There's no doubt that, as you pointed out, it's an energy crisis. And the problem with an oil situation like this and energy shortages, once we get to it, is that it affects anything. It affects every single stock in the market. And one thing is oil not coming out, but there are definitely more products not coming out from the Strait of Hormuz. They also produce aluminium, they're in fertilizers, they are in well, you explained it. There's so many things.
Helium, there's a huge amount, and that's what we're going to talk a little bit about today. Is not just we've done a lot of webinars recently on the 3-point playbook and how to find good stocks, how to exit them, and things like that. This is going to be more about sort of the prelim work that we do for our clients, and that will sort of give you a peek behind the curtain of the kind of things that we look at. So when the Iranian situation kicked off, the first thing that we started doing was researching exactly what comes out of that region, because we knew it wasn't just oil and gas. But even if it was just oil and gas, still research what the repercussions are there. So when you look at the oil industry, they have a lot of very energy intensive other industries there, because the oil's coming out the ground, the gas is coming out the ground. They might as well connect their factories directly to that source, so they don't have to pay for it to be transported. So the Straits of Hormuz and around there, they generate about 9% of the world's aluminium, which is used all over, from tin cans to cars to everything's got aluminium in it pretty much. And the smelting is incredibly energy inefficient there. So they use an awful lot of LNG, normally liquid natural gas, to fire these things. So that's an area. Helium is another area that our research came out with, that actually there's a large percentage of the world's helium gets produced there, and it's not just making your voice sound silly and by inhaling balloons. It's actually used in medical areas, in MRI scanners, and it's used an awful lot in chip manufacturing, which we're doing a fair amount of at the moment. A lot of the big chip manufacturers have 6 months, up to 6 months, they say, reserves that they can get away with. But then we start looking at, okay, if suddenly everything started going tomorrow and we could get shipments of liquid natural gas around the world, oil around the world, helium around the world, how long is it going to take to get there? And that's probably 4 to 8 weeks. So we're already 3.5 months into that period where these companies got to start operating without reserves, and that's some of the work behind the scenes that we do.
And one of the things that we concrete do is that we send out a market scan every morning before 9 a.m. It's available on mystockscanner.com, and it's Hans Henrik, your partner in crimes when it comes to mystockscanner.com, the website that you guys built together. And he gets up in the morning and he sort of taken a big look, an overlook, helicopter view of the market, meaning that he looks at the macro events that are shaping the markets. It's not something that you can invest in, and it's not sure that it pokes the market each and every day. We can see that right now. If you looked at the market, you're kind of going, what's the problem here? Yeah, oil is a bit pricey, but there's nothing really bad going on. And then you guys sit together and you talk and you try to pick out stocks. And right now, it's what you call a stock picker's market. For somebody who's new in investment, try to explain what that really means.
What it basically means is you've got to actually pick the areas you go into quite carefully right now, and you have had to for about a year now since Trump won the election, and that's pretty much because there's not one theme that is continuously carrying on an investment theme. Like AI has stuttered a bit, and Nvidia's not really gone anywhere since August last year, so we're talking about 6 7 months now. So that was a theme that the market jumped on, and that carried on for about 2.5 years. There aren't any themes, and there haven't been any of those sort of themes for a good year or so now since Trump's got into power, and various other things have happened around the world. So that means that there's still money to be made in stocks, but it's not just as simple as go and buy Nvidia and sit back and drink a pina colada and forget about it. This is actually doing a little bit of research, actually understanding the macro, what we call macroeconomics, so the big factors like oil supply, what's the oil price, what are interest rates doing, what are a whole host of other things like gold and commodities doing at the moment, and how's that affecting foreign exchange reserves in different countries. This is all the kind of heavy lifting that we tend to do, that a lot of people, a lot of investors either aren't interested in, they haven't got the time to do, but they know it's quite important. So that's where the market scan comes in. A lot of the work that we do, putting out articles and information to people and teaching people. If you look at it like this, if you look at this information, this jobs number that comes out of the US or Europe in this particular way, this is the effect it can have on the particular stocks that we're looking at the moment. So, and that will drive us towards particular sectors and particular industries.
During the next 50, 45, 50 minutes, which means that we'll be good and done before the football game, to those who worries about that.
Oh, sorry,
Uh,
I just nodded off there for a sec.
yeah, it's not something for Irish people, I can tell you that. You're already out. But anyhow, I promise not to talk about that. We
You
will be
did. You
talking,
failed.
I did, I just mentioned it. But we will be talking Entoro Resources. We'll talk Coca-Cola, Norsk Hydro, Vestas, Kongsberg, Anglo Ashanti Gold, because gold is a place to go in crisis. That's what we're talking about. But first of all, Liam, we're going to talk in specific about the portfolio that is the 3 Point Playbook that we put together. Because right now, when I look at the 3 Point Playbook, one thing is that we're a little bit down, about 2% at the moment, which still beats the market. But we're also very low invested. I think that are we below 50% at the moment, which means that
Well
we're
below
50%
50.
cash? We're
Yeah.
well below.
Yeah.
But take us into the machine room for the 3 Point Playbook and tell how much have we invested, and give a little bit of an indication to what we are invested in.
Okay. Well, for people who don't really know us too much at the moment, we teach a way of investing called the 3 Point Playbook, and it asks three very simple questions: Is this a quality stock that you're looking at? Is it undervalued? And is the timing right to buy now? And we give you tools and show you how to apply those tools and techniques to identify good stocks, and they give you a good percentage chance of being right. And actually, the more important thing there is, if you're wrong, you don't get killed as much because in the market you don't lose as much. So we're as focused as the upside, or on the downside, sorry, as we are to the upside. So you can see here we've got three different charts in this section. You've got the blue line is our portfolio, which looks very pretty, comes off there and drops down a bit, pretty much in line with the S&P 500, which is this line here, and that's denominated denominated in euros. So we're actually saying we're sitting here in euros. If we'd invested in the S&P 500 last year in euros, we would be below water. We'd be about or 2% down overall. The same way, if we'd invested in our 3-point playbook, which we do personally, we'd currently be up 31.4%. So that has dropped. And you can see here the second section in the portfolio where it's dropped down to. So this is a drawdown last April when the tariff tantrums happened, and then sort of Trump did his first taco going up here. So we dropped about 7% or so in the market, and we've just beaten that record now. We're down to about 7.3%, I think, overall, as a drawdown. And drawdown is just measuring that drop from the very top of our portfolio down to the bottom point. And as soon as it gets back up again, like up here, as soon as it got down and then went back up again, the drawdown goes to zero and you go along happily. So generally along the way, we're 2%, 4% in drawdown at any one time. And yeah, we're aiming for less than 10%, and we're hitting that at the moment. And the way we do that is by coming in and out the market at various different rates. So we're currently 35% invested. So we've got 65% of our money in cash. And that is basically a function. We'll talk about the rules in a second as we go through a couple of the stocks. But that's pretty much because we've been sent out of stocks, either in profit or a loss, but never a particularly big loss. And also, when we look down here, just scroll down a bit, we can see that actually this is our first losing month so far, out of the last 15 or so, which isn't too bad. But you can see one of the keys to where we use the playbook and how we try and minimize our risk and our downside is by making sure we're actually diversified across different sectors. So you can see here we are not in any particular, heavily in any particular sector here. I think 18% is probably our biggest with energy, and that is simply because from a macroeconomic standpoint, we've looked at it and said, well, actually, at the moment, with 20% of the world's energy disappearing and coming off the markets, the place to be is energy because the prices are going to go up. There's no way they can't.
And that little cake that you have different colors on right now, of course, is the diversification that you have right now. But there's something really important as well, Liam, and that is that you are not heavy into one specific stock either.
Yeah. So whenever we go into a stock, the maximum position we'll take is somewhere between 2 and 3.5%, generally 2.5%. And that's the kind of thing that we try and push people towards and suggest to people, because that effectively means that if one of your stocks goes down by 10%, it only affects your portfolio by 0.25%. So it doesn't, it doesn't, really hurt or anything like that. You can manage it. So that's the kind of, that's just another risk tolerance area that we try and teach people in the risk management. To say everyone thinks they can handle a 25-30% drawdown. I've been there. It's not pleasant. I've been there a number of times actually, and it wasn't pleasant any of the time. But it gets easier to deal with as you see more of it, and you know the market will bounce back at some stage. And as long as you've got a plan, then you'll be able to come into these things knowing what made you go into it, what's still keeping you in it, and what it's going to take to come out of it. And that's the thing that we teach with the playbook, to say, okay, this is a trading plan. It's not rocket science. It's quality. It's undervalued. You're buying cheap and you're buying at the right time. So we're really not doing anything complex. We're just giving you some tools that actually make that decision process a little bit simpler.
And one of the important things is that you have a strategy, and you have a strategy for each and every stock that you go into
Yeah.
before you go into them. That means that there's a rule set, as you mentioned here, that will tell you when to get out of it, especially in a crisis, especially in a market that falls. But let's get practical. Let's give an example here. Let's go to Antero Resources and talk about that stock, because that's a fairly new stock. It's in the portfolio right now. Liam, tell us, how did you find it? And tell us the historic in regards to when did we went into it and how did it look when we went into it?
Yeah. I've very quickly, I've just gone straight to the page here because I've teed up a load of them rather than people waiting for seeing things loaded. But effectively, to get to the stock, all you do is hit on search ticker and search for the ticker that you're interested in. There are other tools to be able to search. You've got watch lists and you've got screeners and things like that. But this is Antero Resources. That's the second one in there. So it's already loaded up. And the first place the system will take you to is what we call our playbook dashboard, and it gives you a quick description of the company and what it does. It's natural gas liquids, oil and things like that in the US. So not a bad one. We bought this stock about 3 weeks ago. I think it was the third or fifth of March, something like that. And this was in a direct analysis of what was going on back then, and saying the only way for energy is up from here. What do we look at? And then it's things like currency plays we look at to say, okay, do we want a company that's denominated in US dollars, which is what oil and gas generally is traded in? Is that going to be a strength for it? Is the dollar going to go up as well? And we guess that yes, it would, because the dollar tends to be a safe haven in crisis. So it's a good place to, if you're going to own assets, you want to own assets where the currency is going to go up, because actually you get a boost and a tailwind from that as well. So
And also the thing is about dollar that dollars are going up. It's not because it's strengthening, but it's because people are using more dollars. They're asking for dollars in this situation because, as you said, oil is the commodity
it's
at,
it, yeah,
at
it's a bit of both. So because oil prices have shot up, and we know, you got the spot price, and we've got the spot price over here, which is oil is where are we? $100 a barrel, US oil, like crude. That's that. But we know it's being traded in Singapore and places like that, actual physical barrels of oil for 160 to $200. So there's a massive sort of difference in what you see in the benchmarks here compared to everything else. So yes, you do see a big uplift because people need to exchange Singaporean dollars for US dollars to be able to buy oil. Um, but you also have that risk off, that flight tendency where people say, okay, I'm just going to sell my stocks and I'm going to go into a safe haven currency. And the US dollar, as the reserve currency of the world, is always viewed as that ultimate reserve currency that you can just park your cash there and you'll be able to get it back in 3 months' time. That's the belief.
and to our resources, as said, we picked it out like 3 weeks ago because we could see where things were going, and energy seems to be the right place to be. And then you did the analysis, the 3 point playbook, where we look for quality, we look for upside, we look for timing. Take us through the three
Yep.
steps.
Yeah, the dashboard gives us those 3 steps, and I'll flit around the system very quickly just to sort of give people a good overview of what we do and what we look at. So, um, I always say to people that I can use three metrics on this page to tell me whether I'm interested in a stock. And within about 15-30 seconds, I can tell you whether I actually want to carry on looking at a stock or not. And that is the quality score, which is 61 out of 100. So it's in the top 39% of the companies in the US in this instance, because that's where this company is domiciled. The earnings, this is the current year, or the last actual annual earnings that the company's given us, and that's $2.03. It's over doubling in the next 12 months. That's according to the analysts. So we tend to use we don't tend to use analyst price targets because there's a lot of nuance in there. You don't know why they're putting that price target. You don't know who they're talking to or anything like that. But we do tend to find that their actual estimates of earnings per share is pretty good, and estimates of sales, because they do the heavy lifting. They go and talk to these guys. They go to the factories and look at what how they're set up and how they're running. So they tend to have some good information there. So if they say $4, we're going to go with that as long as they're not too far out. And we've got some tools to work out sometimes whether the analysts have been good or not. So earnings per share and quality score, and then the PEG ratio is the last thing, and that is effectively saying how much of the growth of earnings here, doubling, is actually baked into the price, and anything below 2.5 means that actually there still should be some upside. So I know when we go on to our next question, the valuation, that what's probably going to be waiting for me is a chart that actually shows me that the price should be going up quite steeply in the next couple of years, all being well. So that's that. Everything else, green is your friend on the dashboard. So and red is something that we don't particularly like. Revenues are going up, a bit like earnings are. The analysts, they've put up their analyst estimates by 26% on their earnings just in the last 30 days or so, and by 13% in the last 7 days. The returns on capital and returns on equity, we teach a lot about what these mean, but they're effectively how efficiently a company produces profits from the dollars of cash that you give it, or the money that you give it, the investment that you give it. Free cash flow, incredibly important metric. It tells you actually how much cash is being generated by the company. So it's basically the bank balance at the end of the period and minus the bank balance at the beginning of the period. It tends to be more difficult to screw around with the numbers and earnings per share. So I tend to like using this as much as anything else to spot any manipulation that might be going on. Um, so having strong free cash flow generation is great because that gives them, either you can put your cash back towards the investors in dividends, or you can buy back your shares, which lifts the share price up. So again, your investors benefit from that. Or you can invest in other things, making things more efficient, buyouts and things like that. So you want a company that's generating a lot of cash. We've got the price to free cash flow, which we like to see below 35. That's just literally dividing the price of 44 by the cash flow, which I'm guessing is around $4.50 per share here. So it's coming out to 10. So that's a good metric. That shows that actually, based on the amount of cash the company's generating, it's quite cheap as well. And then we've got some debt metrics in here. We can ignore the current ratio for certain companies. Big factory or industrial companies tend to have a lot of assets and a lot of liabilities, which is what this shows us. But the interest coverage says that out of the profits the company makes, it can actually cover its interest on its debt 10 times. So that's a really, really positive sign. Further down, so that's the first question. Question one is it quality company? To be honest, I knew that from the fact that 61 quality, earnings per share is doubling, and the PEG ratio is fantastic, and the rest of it's really icing on the cake that we look at. As we go down, we've got the other two sections we actually show on the dashboard as well. But what I'll do, I'll pop into the larger screens here where we can actually manipulate the data. And we can see here, Antero Resources, we bought it around about here, something like that. So it was down here. We were looking down here and we were saying, okay, we think that in a perfect world, um, the stock, I'm just going to line up. So our value chart is basically here to say, is this stock cheap or is it expensive? And we have the analyst numbers in here, and then we have three of our own sets of numbers that we can play with. And what we tend to do is we tend to map out, okay, if I map out, align my bear case, my worst case scenario with the base of the worst place that the stock has been over the last years. And that's really mapping this red line to the peaks and troughs. This one's more difficult to do because Antero Resources have had quite a volatile session for the last few years, but we'll see it's a little bit simpler with the next stocks that we do. And then I get the bull case, sorry, which is what the best case scenario that we think a company will come out with, and we line it up with the tops. I mean, you could actually go up here if you wanted to, but I'm just going to line it up with the current peak where it is at the moment. And then I tend to put my bull and my bear case just somewhere between the two. If there's a good place to put it, and we'll see some of those as we go through in the other companies, then great. If not, just equidistant between the two, just equal. What that tells us is based on earning, the PE ratio, which is what this line is really doing, and the earnings per share, you multiply those two together and you get the future share price. It's as simple as that. This is not difficult rocket science stuff. We're just basically saying, in the past, in the worst case scenario, analysts have been prepared, the investors have been prepared to pay 14 PE, which is 14 times for each dollar of earning that they've got. And we think the price at the end of next year is going to be $4.37. You multiply those two together and you get 62.36, which is what you see here. And that is a 41% increase that we think in the worst case scenario. So if everything goes to pot, we still think we will see that. So this, if we hold for that time, it might go up, might go down, might go all over the place, but we think it will probably end up around there.
And the thing is that now you move the lines to where it's supposed to go from today. But we had the joy of 3 weeks ago seeing this one. There's no, let me rephrase that, because I was going to say there's no way it could go wrong, because there's always something that can go wrong. But that was a shoe in right here that we knew the stock was up for grabs.
What we're doing is we're playing the odds effectively in the casino that is the stock market, and we're saying that we know that if we buy a quality company, which most people want, and we buy it when we think it's cheap, and also we buy it when we think it's actually in an uptrend and it's about to go up further, that should swing the odds in our favor to say, okay, if the worst happens, we might drop 10%, we might drop 15%, but we're not going to drop 50% like we see some stocks do in the markets, some of the big meme stocks. So that's where we're focusing here, is managing our risk to say, and managing our exposure to say, actually, what we're looking at is saying we want our downside. Say this was minus 10%, we would want to see at least 20% in our base case, that what we think is going to happen, before we'll consider it. So that gives us a 2 to 1 odds on actually getting it right. And
And one thing, Liam, that's super important that we always do is, and Hans Henrik always used the phrase that we want a freight train. We want somebody who's made cash and made money over a long period. Newer companies have a tendency to skyrocket up. That's what they can do in a market, but they haven't shown they can make money. And we basically always take companies that make money.
yeah, the way I always put it is, I want to see boring companies. I don't want to see companies that go to the sky and everything, like quantum stocks we've looked at before. And I've done the tech reviews of some of the quantum stocks out there. They don't make any money. They've got no history whatsoever. So we would far rather see a boring old company. We're going to talk about Coca-Cola today, for instance. Boring as hell, but there are opportunities there. So that's what we tend to look at in here. And what that is, I mean, Terra Resources is not a great example of this, but what most of the companies we choose give us is dependable earnings going back, so that we can say, well, earnings have been this for the last few years, therefore they're probably going to carry on going up, and that's what we like about it. And Terra Resources, the key thing with the current situation, when you look at a stock and what drives it going up, you're not just looking at the stock and the company itself, you're looking at the sector it's in. Is that going up? Are the other companies going up? So investors feel happy with doing that. And also the index that it's in, is that going up? So we've seen stats before that show about 60% of an upside of any stock can be a mixture of the sector, the industry, and the index that it's in. And the 40% is how good a quality it is.
And that's it. It's basically a herd of elephants that we're looking for, and we are looking for a herd of elephants that's in movement forward, and that's what we knew about energy up 3 weeks ago. It's
Yeah.
that's why we chose it. But then the timing. Now the timing, the last bit of the equation here for
Yep.
the 3 point playbook is, was the timing right when we went into it? And well, that kind of tells the story
Yeah,
of its own.
we're up. I don't know what it's up today. We were up 13.5% yesterday. It dropped a couple of percent, didn't it, on Monday? So we were up 15% when I looked at it the weekend. And yeah, I've got this in. I run 5 portfolios based on the 3 point playbook. So I look at it all the time on my particular broking system. What we see here, this is just a very simple chart. We've got a few lines on it. So this is the price. The price candles here, so we can see it going up and up and up. We have down here at the bottom, we have something called the MTI, and there are 2 lines here. One's on the daily series, the top one, and one's on the weekly series. They're exactly the same. They effectively tell us, is the stock in a good, strong uptrend? That's it. Green and red. No, very, very simple. And green is good. Yes, it's in an uptrend, or it's just starting an uptrend. Red is okay. It's just going into a downtrend or sideways movement. Sometimes you can sometimes get sideways on the greens as well. And so that's that. We're looking for greens, double green on here, or the daily moving into green, and a really good reason why we believe that the weekly is going to go to green quite quickly, because that tends to move slightly slower than the others. Then we've got 2 particular averages. I've got a third one here. I've got a 20-day moving average, but the key ones here, the 50 and the 200, the green and the black lines. We want to see the stock going above both of those lines. The red one moves really, really quickly, so I just use it as a guide for momentum sometimes for my particular eye, so that I can see what's happening. So here you can see the stock was down here. It came down, it skirted along the green line, and then dropped, and then acted as what we call resistance with the 200-day as well. So basically, the stock hits it, might go up a little bit, but then gets rejected and coming along. So that's the kind of thing that we look at and say the stock hasn't got any real momentum behind it. So as the MTI is turning green here. We're saying, okay, it's the MTI is telling us in an uptrend, but actually our eye is saying it's being rejected. If this had come down here, come down there, and then bounced, then we would have pounced onto the stock. And that's a sort of trading sort of mechanism that we look at, and pattern that we look at. Nothing particularly complex again. It's coming up, testing this. Is this now support? Yes, it is. And then we go from there. We came along for a few more days, came into March, and everything started taking off with the invasion of Iran. We bought, I'm sure it was on the 5th, something, 4th or 5th or something. So we actually saw it come up, come back down, and then start to go back up again.
And
And that's what we
that
jumped.
is a sort of a pattern that you look for, is that it goes up, it comes down, and then it takes off again. That's what you're looking for in each and every stock. Liam, we spent a lot of time because we wanted to go into detail to explain sort of the tactics here in regards to picking the stocks. We have a slew of stocks that we want to show you and talk about in conjunction with being in a crisis, that you can go what you call defensive. This was almost an
Yeah.
offensive play in that sense, that we knew energy was threatened as soon as the war started, and we knew that was going to be a question. But you can also play defensive, and one of the stocks that people love, Warren Buffett loves it, maybe because he has millions of them, and that's Coca-Cola. You just mentioned it. We're going to take a look at Coca-Cola because it doesn't matter what's going on in the world. People somehow will have a Coke, maybe they'll have a Smile, what do I know, maybe they want Pepsi. You can invest in Pepsi as well, for that matter. That's also a defensive stock. Why is Coke such a good stock when the world is in turmoil?
Um, but that depends actually, and that's a very nuanced question, because actually it hasn't been for the last couple of weeks. But what we're looking at, you tend to have stocks that are split into two different categories. There are, as you say, there are offensive stocks and there are defensive stocks. The offensive stocks are all ones that have a lot of momentum behind them. They're generally the growth stocks, and generally the ones that do well in bull markets where everything goes up and they get dragged along. Doesn't really matter what the quality is. When the shit hits the fan like it does at the moment in Iran, and that's causing all these repercussions around the world, then you're moving into a defensive position, and stocks that have solid earnings that don't get too affected by recession are key ones that we look at. So they tend to be consumer staples. So the stuff that people need. They don't need necessarily need new cars or anything like that, but they do need to eat. They do need tools to do things with, and you could put computers in that, but that's a slightly different thing. But the things that people need, that's a defensive area that people go into. You've also got sometimes financials can be. You've got energy companies, you've got utilities, tend to be those sort of things, because they're giving good dividends a lot of the time as well, and that tends to be a good area for a defensive stock.
And then we also look for things when we're in crisis. We also look for things that are cheap, the cheap small enjoyments that is a day, and that could be have in some countries having a Coke. That could be something that brings joy, and it's not
Yeah.
too expensive. So you basically spend money on something that seems like a luxury, but it's not really.
Yeah, but it gives you that buzz maybe, and Coke is a stalwart for that. If we just look at the playbook very quickly, I'll run through it, and you'll see sort of my 15-20 second rule. Quality score 95, earnings per share is going up very nicely, PEG ratio high. So actually there may not be that much in it, but we'll see. Sometimes it is different. Return on capital, return on invested capital, great. Return on equity, 40%. It's in the red because it's come down, but 40% is insanely good.
Insane. Yeah.
So that is great. Free cash flow has dropped recently. Probably need some investigation into that. Price to free cash flow is quite high. We like to see it 35-40. Interest cover is absolutely fine, and the current ratio where it's just assets divided by liabilities is fine as well. So high quality company. We all know Coke. We all know it is high quality company. From a valuation perspective, you can see the chart that we've got here. Now, this is where some of you need to look at your risk tolerance and understand where you put the line. So here, I've actually moved my line so that it matches the bottoms in 2023 and in 2020. So this was the lowest point of the drop in COVID. This was the lowest point of the drop in the inflation scare in 2023. So from macro events, they're pretty big. Over the last 5 years, they're the biggest we've had. The COVID drop was around a 30% drop in the market, something like that, within a couple of weeks. Inflation was just a long-running roller coaster that, just killed most people, I think, in the market of boredom and just things moving around an awful lot. So I put it there. You could argue that in today's world, you put it up a bit there. So, but I'm just going to leave it where it was. Also, from the green point of view, do you mark the latest peak as the peak where it's going to go in the next 18 months? That's what I'd probably look at, but it's well below where investors had paid for in the past. And then the blue line, generally, I mean, the analysts are pretty much in the middle between the two. It's bounced on the analyst line, which is great here. So that's great for me. So what that gives us is it says that in 18 months, if investors are happy to pay a PE of 22, which is it's just a multiplier. That's all it is. It's
Yeah.
the price divided by the earnings. But we do it the other way. If they're prepared to pay 22 and the earnings really do get to 3.46, then the worst case scenario is we break even. Best case scenario is we go 20% up, and in the middle is about 10.5%. That's almost enough to get us out of bed. 15% I'd like to see. So I'd actually like to see Coke drop a little bit more, or we become more convinced that actually they can hit their highs up here, which gives us a little bit more room to maybe say, okay, we think it's a bit more undervalued than it was. But for me, it's a little bit lower than that. So I just drop them down here. But it's something that would be interesting to see whether we go in from a textbook kind of thing. And this is where the macroeconomics comes back in. So it's not just at the beginning when we're deciding on quality. This is actually looking at why the hell did Coke drop as a defensive stock? So, what's happening here that's caused the stock to drop? Um, an awful lot of fertilizer gets produced. It's very, very energy intensive to create fertilizer. So a lot of that gets produced in the Middle East. One of the byproducts of fertilizer, we saw this during the Russian Ukraine. The Russia attack into Ukraine, is that a lot of CO2 that gets bottled and sent out to people, to companies like Coke, to put in their products, it's either massively expensive or just not available. And I would suggest that is probably, I haven't looked into this, but my gut feel is that is why we've seen this drop here, because suddenly their raw products have got a lot more expensive, and also shipping the stuff around has got more expensive.
Can I ask in regards to that, because I know that you guys are looking at so many things and you also look at the news and stuff like that. Like for instance, here in Denmark, there was the bit in and around that you wanted to boycott American goods
Yep.
because of the way that Trump behaved. Is that another factor that you guys sort of take into consideration when you look at these stocks?
It is, sentiment has got to be, you got to look at it on an individual basis a lot of the time for the company. So like Facebook, is something I wrote about today in my tech story. Facebook and YouTube have just been their knuckles wrapped by the courts in America because they produce products that are addictive for youngsters, mainly sort of Reels and Instagram and YouTube. So yeah, we look at that sort of thing and think, is that enough to actually really endanger the stock's brand? Um, but from the America side of things, we looked at that and thought, from a macro perspective, I mean, we're using a system called Restream to stream our video on. That's American. We're using Microsoft Edge, or I'm using Microsoft Edge as a browser. You're probably using Google Chrome or Safari, all American kit. Yeah, everything is American. We can't decouple that easily. So from an individual company point of view, it's important to understand where the problems are. Rheinmetall is a really good example here. In the news today, the CEO is slagging off Ukrainian wives making drones in their kitchens. That's only going to go one way for Rheinmetall. That's going to damage their brand and should damage their share price as well, potentially. And it's pretty disgusting what we said anyway. But yeah, I've just got actually Rene has just come in and said he's sold at 77. Pretty much, yeah, just above the 50, but not a bad place to sell. And he wants to come in at 65. Um, it'll be interesting to see from a playbook perspective. I mean, I know you've seen sort of a lot of our webinars. What we tend to say to people is that once a stock actually goes below or is hovering around its 50, it tends to stay there until it's got a reason to go up. And that's why we say, actually, we wouldn't have been in past this point. We might have got kicked out of the stock here, for instance, if we were in it back then. Um, and we wouldn't have been in it. We would have missed all of this drop because actually we were waiting for this point where the stock goes up above the 50, drops back down, uses the 50 or the 200 as a bit of a trampoline, and then goes back up again. We might have get shaken out of it here and then maybe back into it back there. But these averages tend to an awful lot when you look at if you look at lots and lots of price charts, they tend to act as either resistance point or a support point. So everyone's got to have a strategy, and I'm not saying your strategy is wrong. I'm just saying from our point of view, we always say 50 is a good one.
And one of the things that is important in our strategy as well, Liam, is that we're not afraid to go back into stocks that we have been shaken out of. We'll go back another way around. We're not in love with a specific stock and stay in it, even though if it's dropping below the 50
Yeah,
or the 200.
yeah, we don't care what the stocks are. It's just, are they going to make money for us or not?
So right now, not an upside for Coke, and also the MTI. I can see that on your screen is that
Yes, they
it's the
use red.
timing is off as
Yeah,
well. But let's jump to because we have a slew that we need to get through, and
yeah.
we have
I'll
about
get
20
quicker.
minutes left. And let's go to a stock that has been, well, we have danced with the devil here, and it's nothing to do with
Well,
Norwegians or anything.
Norwegians.
No, 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 no. I'm not going to say that. But it's a stock that we really like, and we pointed it out right away because of the macro side of things. Hydro, Norsk Hydro, is a producer of aluminium. We saw that right away with the Middle East, that the crisis down there, Strait of Hormuz, a lot of aluminium couldn't get out. We looked for an aluminium stock, got into Norsk Hydro. You do the historics of our little dance with the Norsk Hydro devil, so to say.
Yes, yeah, it is. It's a really annoying devil actually because we got shaken out of it last week. We went into it and got shaken out within 2 or 3 days because it just dropped for no reason whatsoever. The reason we went into Norsk Hydro, you can see here from a 3 point playbook perspective, the quality is 80. The earnings per share is shooting up according to the analysts. The PEG ratio is great. So within 10 seconds, I know, yeah, this is a stock I really like. And Hans found this one. Returns are going down. I would suggest that is probably, if we looked at the figures, it's because of investment into capital expenditures. But the free cash flow went up last year, which is great, and it hasn't got a debt problem. We went into it looking at this. It's actually, we tend to prefer going into it with a stock that's actually coming along the red line, and certainly not going to the green line. But there is so much upside just in this year, let alone next year, that we looked at it and said it's a no-brainer. The reason we really, really liked it is because actually aluminium smelting is hugely energy intensive. So they use bucket load, well, actually barrel loads, I guess, or shiploads of liquid natural gas that come in to fire up their smelters to do these things. Which and everyone was looking at these companies and saying, well, actually, they're not going to be able to do that at the price they originally could, simply because their raw materials are going to go up, their LNG price is going to go up, and everything. However, Norsk Hydro have got a massive supply of hydroelectric power that they use. So we looked at that and thought, we're brilliant. Well, we've found one of the few stocks that actually have their own source of power. They don't care what LNG does. And then the bloody stock drops by 8%, I think, last week on one day. So if we look at that, we can see it dropped out. Let's just go to yeah, it dropped out down here. The moving average was down here. I'm on the wrong page, but and it then shot back up again. So it's one we were shaken out of.
And
It's
again,
okay. These things happen.
but again, Liam, it's because we have the rules, and we can't really just change the rules every time that we feel. But
No,
we know it's a good stock. If it goes under the 50, then there should be a bloody good reason to stay in it before it hits the 200 if
exactly.
that's below
And
it.
everything was going down. So our basic premise on what we're looking at for the Iranian war at the moment is that this could tip us into a global recession because the damage has been done now. So a lot of the, if countries like, the Asian countries use a huge amount of imported energy. They don't have their own energy. So they are going to start struggling. We're already seeing air flights being 20% being dropped in certain countries because they haven't got the aviation fuel to go with it. So we're looking at a potential sort of recession coming in, and everyone, we're waiting for a lot of these stocks to drop and carry on dropping because the thing is, Norsk Hydro will probably go up for now, but at the end of the day, their demand will start dropping because of the macroeconomic forces are they're working here to say there's not as much demand from clients because they're not building as much, they're not making as much. Therefore, this will drop. Factories will go out of business. Everything will reset, and then we'll start with a new bull market. That's how that works.
And Norway is in a really good position for a lot of reasons. Of course, they have their oil, but also because they have fertilizer that they're producing up there, Yara International. They have Norsk Hydro, and that's why the index in Norway went up by more than 3% yesterday. We're not going to go further into Norsk Hydro because I want to segue into something Danish that we have sort of seen also have been on our radar ever since, well, for other reasons really, but with the energy crisis coming our way, of course, we have to talk about Vestas because that's a no-brainer for a Dane in that sense that if we can produce our own energy, why don't we? So take us through Vestas and the three-point playbook and see how it plays out because it's on our radar. That's no secret. It's not in the portfolio right now.
Yeah, we looked at it. It was part of we do a face-off every Friday between two companies, and this was Vestas and I can't remember which other company it was, but
Siemens
oh,
Energy.
Siemens. Oh, okay.
Yeah.
So two in the same sort of area. 3-point playbook analysis, 58 quality, okay, acceptable if everything else is good. But everything else is good because you can see here earnings per share is looking like it's shooting upwards. The PEG ratio is below 2.5, fantastic. Analysts like them, they're not rating them down at all. It's producing cash, it's doing everything in the right way there, and it hasn't got a debt problem. So that's great. Big tick in the box for the quality. From yeah, the chart doesn't look real in a way because it's just going virtually parabolic up. What we're saying is in the worst case scenario, so this is going back to May the 8th, the bottom of the market or the bottom of the stock last year, also tying up with the bottom of the stock back in 2020 when COVID happened again. We can see, yeah, we're saying, okay, that's the bottom. So we placed our red line there. The analysts, I don't know what they're smoking. In a time when we're going to need as much energy as we possibly can, and this company's offering it in spades, and they're very good at what they do. I don't know why they're saying they're not going to grow that much. And we're saying the maximum here, if the stock picks up, is up to 81%. The minimum is going to be 13%. And then I put the bounce in here because that's pretty much where the stock has been all the way through. So actually, what we think is going to happen: 41% upside, 13% in the worst case scenario. That's not a bad play. From a pure timing point of view, actually, the stock took a bounce and went up again. Ideally, I'd like to see it drop back down and then bounce back up again, but actually it could just carry on, in which case it'll probably be a buy from our perspective.
And again, we are starting out at the macro side when it comes to a crisis situation because we are definitely under the influence of bigger powers than just the market itself. That means that's why we are so looking at energy right now. And also because the long-term effect, Liam, of what's going on in the Middle East, it's not solved, even though that they might be a ceasefire tomorrow. They might stop all the war activity and go home, but this is going to linger. It's going to last.
Yeah, and if you read the news, you can get a lot of free news out there from Yahoo, from investing.com, from CNBC, and be careful with that sometimes. But you can read very quickly that actually 20% of a lot of the oil and gas producing equipment has been damaged over there, and it's going to take 3 to 5 years to replace it. So we are going to be stuck with an energy deficiency for quite a while now, and that's going to affect people. And that's why companies like Vestas are important. The other thing is, it's always important to understand, we were talking about reputation just now. Vestas actually lost a couple of contracts in the US because Trump closed them down because he doesn't like windmills for some reason. And those are the sort of things you need to watch out for as well. A particularly hostile country that suddenly decides it doesn't want this technology anymore can take its ball away and not pay for it anymore. So those are the sort of other things that we look at, and for a company, what the longevity is for their contracts.
We're going to look at gold shortly because gold seems to be a safe play whenever there's a crisis, but maybe not so fast this time. We're going to say we'll look at that in a second. I want to go to another stock that we mentioned already. We're going to go to Norway again and look at Kongsberg because again, if we look at the macro side of things. Liam, we talk about it all the time that Europe has to look out for themselves. We are going to opt our defense and stuff like that. But the question, of course, is there any more in the tank in that sense that is there any more money to be had in these stocks? And Kongsberg might be I'm almost going to say, only one of the European stocks that the defense stocks that we find interesting. But also, again, with the macro side of things, the things that Trump are saying right now, well, it seems like the Europeans are going to man up and boot up in a hurry.
We're on our own effectively is the message coming out just in the last couple of days, let alone last year or so. And the annoying thing on here is that Trump has got a point. All the countries in NATO apart from the US have massively underspent because you've got the US backing it and so on. So there is a point. It's just the way you make it sometimes is the thing that makes or breaks an argument. Kongsberg. It's in Norway. It's a Norwegian company. Big company, very good quality score. We've been in it last year. We ran a series of webinars on defence stocks last February because we saw the macroeconomics were moving in that direction. We bought into 4 of them. I think our best was Rheinmetall, which is 176% up. Kongsberg was pretty good as well in that regard. But you can see the analysts love them. PEG ratio fairly high at the moment, so it makes me think when we go to the value chart, it's actually not going to be as much upside there as we expect. Revenues are shooting up because everyone is looking to tool up, as you say, from a defense point of view. Returns on equity, returns on invested capital are great. Free cash flow is good. So everything works really, really well. So big tick in the box for the first question. I just reset these and get rid of the risk-free rate. We don't need that. So if I just look at this very quickly, I'll come down and say, okay, the worst case scenario could be that we go all the way down to December this year when I don't really know what I think investors were just bored. Maybe I don't know because we're still shoveling 2 trillion euros into the European defence industry over the next few years. So that the money's still there. I think what really happened was you had this massive boost coming up here, and we got onto it around here and rode it all the way up and then a little bit down again afterwards, and then came out. What people realised was that okay, you can have 2 trillion euros thrown at something, but that doesn't. It takes 4 or 5 years to build a factory that actually allows you to make them and actually get that 2 trillion euros through the door. And that's the realization I think that we saw in investors over here, thinking actually we've done this. It's been a really good run, but it's going to be a few years before we see any profits. So let's come out of it now because we'll just take those profits. And now what's happening is with everything going on, it's starting to boost back up again, and there's lots of talk here. So from a valuation point of view, if we held, this is where the disparity comes in. You can see on the left hand side here, if we just hold for a year, the bear case is 27% down, so negative, and the bull case is 15.5%. So to me, our average holding period for a winner is about 90 days, 80 to 90 days or something. So we're looking at coming out somewhere around here. We're right up at the green zone, and is there much upside in here? Yes, the stock could carry on going up. It doesn't need to listen to us and adhere to this green line here. But we think the odds are it's probably going to come down. When it does come down, even if it comes down to the blue line, would be very tempted to pick it up because all of a sudden this suddenly switched around. This drops down 15%. That's suddenly a 10% loss and maybe a 15% upside, which is really getting there, within our within our crosshairs. From an upside point of view, you can see here it's adhered beautifully to the red line in this case, and it's bouncing very nicely off the 50. So we see potentially that carrying on in an uptrend. It's still in an uptrend in our case. So if we were holding it and we'd have come in maybe around here, something like that, we would still be holding it now and breathing a sigh of relief it didn't go below the 50.
And that's the thing also. One thing is to ride your winners long, that you don't get out of them too fast. One thing for sure, we don't get in the bottom, but it's very hard to get in right on the top
Yeah.
because basically it needs to go down a little bit and start crossing lines, and that's when we're getting out. Liam, you're saying here that Norsk Hydro is one of the annoying ones. Kongsberg could be annoying in that sense that it's just too expensive at the moment. You said we have a lot of money laying around in cash in our portfolio right now because we're simply not very much invested. Why haven't we bought physical gold? Because that's the thing, Liam. When the world's in crisis, you have to go gold, silver, a precious metal. That's what the history tells us, isn't it?
Does it?
I don't know. I'm
Um,
asking you. You're the expert. I just get to ask the questions.
it actually it all depends on your timescales. It does in the long term and the medium term. It doesn't in the short term and these sort of crises often. So if you go back in history and look at the price action in gold in 2008, 2020, everyone ran for the exits and just wanted cash. They didn't. You can't eat gold. That's one of the things investors who don't particularly like gold as an investment say. There's you can earn a dividend from Coca-Cola, for instance, 3%, or whatever they're at the moment. So this is a picture of gold, and you can see here that we started off second beginning of March. This is when the war kicked off in Iran, and it dropped immediately. Part of that was due to the fact it's had such a good run over the last X amount of years. So it's really gone up. It was really looking toppy at 56, 5,500. And you've got to remember that these are COMEX prices. So they're an exchange over a commodities exchange over in the US. I wouldn't say they're manipulated, but they're certainly, like certain interest rates are called fixings, and we see a big disparity between the price of gold and silver, for instance, that's traded openly in China compared to the price that's on the US markets. And there's a lot of suspicious contracts and things like that go through. So sometimes these prices are there because people have traded them higher rather than that's the intrinsic value of things. Um,
But
so
the thing is there now a play in that sense that because it came down, you've got your retraction here. You got it down from the highest point where it was impossible to invest in. Should we be looking at a stock that we have been into? Let me bring it up right here.
yeah,
Anglo Gold Ashanti. Couldn't that be the play that we're looking at? Isn't that what we should be talking about here?
it could be. Let's have a look. That's the easiest thing because we've got rules on these things, so it's not just a simple yes or no. We were in Ashanti. We came out of it in the last couple of weeks with a profit. I think it's 20%, something like that. We're also in Barrick Gold, and we have been in for 3 or 4 months. We made around 35, 36% on that, I think, over our investment period, and both came out and were shaken out because of this price movement here. Ashanti, you can see why we bought the company. Massive quality, massive earnings potential, massive earnings potential on the PEG ratio that says it's not even priced in. The returns are great, the free cash flow is great, and so on and so forth. So yeah, fantastic company. Um, and you can see here in this drop that it looks like it's bounced there. In the past, it's bounced a little bit lower, so there could be some more down here. But if it did go up, then yeah, that's great. From here, just this year, that's all the numbers we've got for this year. We've got 102% upside potentially, but actually you could potentially see even more than that. You could probably see 130% if we're going to match that peak up there. But we could just say, well, in the real world, it may not get that euphoric anymore. So we'll just come to mere 100% gain. In the worst case scenario, we think it will be 25% because that's when buyers have come in the past when it's dropped. And we reckon in the middle between those is around 65, 70%, something like that. So it's a brilliant company, and undoubtedly we will be going in there, but not until this bad boy down here goes green, and this just bumps above the green 50-day. It's the job's been made easy because the 50 days actually starting to roll over, which means it's going to carry on going down. So a little bit of upside here, and we'll be above the 50, and it could be an entry point for us.
And again, we are not moving on a stock unless that we can answer yes to all our three questions. Is it a quality stock? Does it have an upside? And is the timing right? That's just a rule set that we have. And Liam, if we need to conclude here towards the end, because we're coming up on the hour, the thing is that the same rule applies to in a green market when things go up. Stick to your rules. Don't take any chances. When you're in a crisis, sometimes the best medicine is sitting on your hands, especially when you're looking to buy.
It is, and it's actually arm yourself with knowledge, and either get your knowledge from people like us, who spend days and days. If I still got the, in fact, I had something else I was going to show, but I haven't got time to show at the moment. But if you look here, on my normal news routine is to actually go in Bloomberg, Reuters, Market Watch, Barron's, Nikkei. So we cover a huge amount of all three of us, you, me, and Hans Henrik, every day, looking at all of these stories coming out and saying, okay, is this investment? Is this a macro story that guides us in where we're going to be investing, and so on and so forth? It shapes our thoughts into where we think the sectors are going, and those sort of things. So that's something that with the market scan and with the tech writing that I do, that's something that we make available to the people that subscribe and follow us online. So that's the important thing. And as you say, have a plan and stick to it.
I'm just going to roll an ad here because we're going to do this again tomorrow in Danish at 7 o'clock. We don't have a football game competing with tomorrow, but we have Easter coming up because the market's going to close for Easter. American market's going to stay open on Thursday and then it'll be closed on Friday, be back up again on Monday. 7 o'clock tomorrow evening, Hans Henrik and I will do this once again. But Liam, one thing for sure here towards the end, thanks for you guys watching. Again, as you say, listen to people who are smarter than yourself. That's why we read all these things. That's why Hans Henrik and you research and research and research. And you got to remember, even though that we are investing in stocks and stuff like that, it's not like you who's watching can't make money of different stocks or even the same stocks. This is not a we take all wins and everybody else has to lose for us to win.
Yeah, no, not at all. And it's about, like you say, the most important thing: have a plan, know what you're doing, have some semblance of knowing what you're talking about as well, and where the macros are taking you, and you can make it in this sort of industry.
And also at the same time, remember when a stock goes down, the amount of energy it takes to go back up again, like for instance, if it takes a drop of 50%, well, if it raises by 50%, you're not even back yet. You
No,
got to
no,
remember
you're
that.
only 75% of the way there. So yeah, managing your risk is the most important thing you can learn. And that's why we focus on that drawdown, on that downside risk as much as possible, because we don't particularly like being there.
And we clocked in at 1 hour exactly right here.
Wow.
Liam, I know that Easter is coming up. That means that you are back on Tuesday, 1 o'clock, with Tuesday Tech, of course. But we will, of course, be active on our platform, mystockscanner.com. You can get a free membership for a month. Go in, test us out, try us, get to read Liam's brilliant articles on the tech industry. And Hans Henrik will do the macro each and every day. And I want to bet that he's working on Easter as well. So I can't promise you the
Better
market
be.
scan,
Yeah.
but he'll definitely keep an eye out for it. Thank you so much for watching tonight. Again, we're going to do it again tomorrow night. But before that, there's the market scan tomorrow morning before 9. There is my stock scanner live at 12 o'clock in Danish tomorrow. Liam Flavel, have a good one. Go get that Guinness. And the rest of us will go put on the red shirt. This time it's positive. It might be green that we're looking for, but red is good tonight in the football game. Come on, Denmark. Let's go to America and kick some ass in the World Cup football. Have a good one, Liam.